The crossover rule is a very well established rule for decision making, whether you want to buy or sell a particular security. And it involves moving averages and when they cross over things. So moving averages, lend themselves to really easily to understand and apply this trading rule called the crossover rule. So as prices move up and down, so does the moving average move up and down as well, and it lags a little bit behind it, but when they start crossing over, that means something's happening, and we want to make decisions around what might be happening around that. So let's talk about the crossover rule and how we can use these moving averages to help us make better decisions as far as traders. And the crossover rule is actually very simple to understand. So basically when you buy, when a price crosses above the moving average, so we have our moving average line, price crosses above it, that shows that that's a buying opportunity. Same thing with selling, where the price is going below the moving average, that's a selling opportunity as far as that. So let's look at that on an actual chart and let's see, well, what does that really mean? But really kind of remember when you're buying and when you're selling. So if we look at the chart here, we can see where the moving average, the blue line, happens to be a 50-day moving average, the one I happen to select. You can select different time frames, of course. And you can see where it crosses over the price line, the line price bar chart. Basically, you can see where it crosses over. And really what you're looking at is you're looking for how this interacting with the moving average. So when it crosses above the moving average line, that shows that the trend, that things might be changing, a trend might be continuing, and the prices are going to continue to rise. By the same token, when the price goes below the moving average line, then it's showing that it's going to maybe continue on that downtrend as far as staying, prices either staying or going lower, as you can see in here in this example. So basically, a simple rule would be, and they don't stay there necessarily for long periods of time. Sometimes they do, sometimes they don't. I mean, if you look at the lines to the left on the far left of the chart, you can see they're well above the blue line for quite some time. Before they cross below, and then you would sell, and then above and buy, and back and forth, and kind of an up and down thing in the middle there. And then to the far right, you would see where you'd buy back in again. So really, if you apply the simple rule is, if it crosses above the moving average line, I buy, and if it crosses below the moving average line, I sell, is the idea behind it. Now at this point, you might be thinking, yay, eureka! So simple. This is all I need to do. This is perfect. I just got to look at a line and whether it's going above and below the line. Okay, well, I'm glad you're happy. That's really good. Nothing's perfect, unfortunately, as far as within the technical analysis world. So don't rely on just one indicator, but it's a good, strong indicator, so you can be happy. Just don't be too overjoyous on it. So the crossover rule is really terrific. It's really easy to understand, and it's a really good, remarkably good predictable indicator, but it's not perfect. There are outliers, and you have data points that pull things far off of trend lines, and then the more outliers you have, far ranges and prices, the less accurate your moving average might be because those outliers are impacting that moving average. So it can give a false signal at times and give you a false signal of a breakout, but you can usually correct that quickly because your moving average is going to go back down a little bit too. You probably saw in that last chart where it looked like in the middle there where there's a lot of up and down going above and below the moving average line. So it was a lot of buy, sell, buy, sell, buy, sell. And that's a challenge, and that's what's called a whipsaw, actually. And you can get with a moving average, and one of the downsides is you can get a lot of buy and sell signals with a frequent crossing period. Where traders are trying to make up their mind: do I keep buying, do I sell, as a massive group? And you can get these frequent buy and sell things, so you're doing more trading activity, which could potentially incur more costs as you keep buying and selling. And it can occur any time, but the most common time where you see a whipsaw is in what we call a sideways market. There's no definite uptrend, no definite downtrend. It's kind of trending in this kind of narrow band, and it's going above and below the line frequently, and that's causing this whipsawing effect of buying and selling. So it could lead to this frequent trading around that. So in the next lesson, we're going to talk about whipsaws a little bit more and how to kind of overcome that a little bit, but understand that can be a part of the crossover rule, but still a an excellent, very good rule as far as understanding when to buy and sell.